Good morning. Welcome to CATEX-TV. My name is Frank Fortunato. This is a live broadcast from Princeton, New Jersey. Today is Monday, March 16th, 2009. It's 11:30 a.m. Eastern Daylight Time in the U.S. It's 3:30 p.m. in Britain, 9:30 a.m. in Mexico City. If you need to reach us during the broadcast, you can phone in toll-free at 1-866-67-CATEX. Overseas, our AOL instant mail address is CATEX-TV. The stock market is up about 110 points. And we have two little bits of breaking news. This comes from Insurance Insider. Aspen Insurance Holdings has parted company with Adrian Fox, described by Insurance Insider as the underwriter at the center of a challenging financial institutions reinsurance program renewal for the company. Former QB underwriter Fox spearheaded the reinsurer's expansion into financial institutions business, which saw the firm become the lead underwriter on programs such as Lehman Brothers. There was also an earthquake today of a 6.0 magnitude under the ocean between Indonesia and the Philippines. As of now, there do not seem to be any injuries, damage, or tsunami alerts issued. Now to our main news. Everything's being primed up for Edward Liddy's appearance in front of a congressional committee on Wednesday. I would not want to be Mr. Liddy. Over the weekend, AIG said that it had paid over $100 billion of its bailout funds to U.S. states and international banks. Here's the list. Not exactly the mom and pop groups. Goldman Sachs, Deutsche Bank, UBS, Merrill Lynch, Morgan Stanley, HSBC. You can read them as well as I can. The cash was used to cover collateral payments, cancel derivative contracts, and meet obligations at its securities lending business after the firm had to be bailed out last year. Most of the major U.S. and European banks were represented on the list, but AIG revealed that Goldman was the biggest single beneficiary from the payments, receiving $12.9 billion. Payments to municipalities total less, $12.1 billion. Bank of America and Merrill Lynch together received $12 billion. Societe Generale got $11.9 billion. Deutsche Bank got $11.8 billion. AIG said in a statement that we recognize the importance of upholding a high degree of transparency with respect to the use of public funds. AIG, of course, had previously argued that disclosing the identity of counterparties could damage its business. The remainder of the $173 billion that AIG has received from taxpayers has been used to repay debt, boost capital levels, and to wind down its derivative contracts. While the payments were not illegal, these are the payments to these banks, the fact that billions of dollars given to prop up AIG were then transferred to European banks and Goldman Sachs could raise new doubts about whether the bailout was economically necessary. The list was made public ahead of Mr. Liddy's testimony on Wednesday. He's expected to be questioned very closely over this. One other thing Mr. Liddy will be questioned on closely are $165 million in bonuses that AIG is planning on paying out to its employees. This has created a toxic mess here over the weekend. AIG declared that it's paying out the bonuses to meet a Sunday deadline, a week from yesterday, but it has agreed to requests by the Obama administration to restrain future payments. The Obama administration has expressed displeasure over the payouts, but the U.S. Treasury has determined that the government does not have the legal authority to block the payments. Larry Summers, the director of the National Economic Council, told the TV talk shows yesterday that the bonuses were outrageous. He said that Treasury Secretary Timothy Geithner had negotiated very forcefully with AIG and that all that was legally permissible could be done. The large bulk of the payments at issue covered the AIG Financial Products Unit in London, the unit of the company that sold the credit default swaps, the risky contracts that caused massive losses for the insurer. AIG says it was contractually obligated to pay $165 million of previously awarded retention pay to employees of the unit by March 15th. In a letter to Geithner dated Saturday, Liddy said that, quite frankly, our hands are tied. Although he agreed that in light of the company's current situation, he found it distasteful and difficult to recommend going forward with the payments. Liddy said that the company had entered into the bonus agreements in early '08 before AIG got into severe financial straits and took a government bailout. Liddy said that the company will work hard to reduce the amounts it will pay out in bonuses in 2009 and believes it could trim those payments by at least 30%. One bank in Europe has responded. You have to give them credit for coming out and saying something, and that's Société Générale, which has some experience in damage control with the rogue trader. Société Générale defended its actions in receiving the money from AIG, from the U.S. taxpayer. It said that that it had completely acted within its rights to call on AIG for cash. We acted, they said, in full conformity with our counterparty agreements with AIG. We issued collateral calls to AIG in accordance with the terms of those contracts as a result of specified credit events at AIG. The collateral posted by AIG was fully consistent with the terms of those agreements. Well, I'll tell you what, if those people at AIG get bonuses in 2009, Mr. Liddy hasn't seen anything yet so far as congressional ire. As it is right now, Wednesday is going to be quite a roast. It's going to be very interesting. Last night on TV in the United States on the CBS show 60 Minutes, a news magazine show, the chairman of the Federal Reserve Board, Benjamin Bernanke, in a rare interview, said that the U.S. recession will come to an end probably this year. But he also warned that the nation's 8.1% unemployment rate will continue to climb. He told correspondent Scott Pelley that concentrated efforts by the government likely averted a depression similar to that of the 1930s. He said that the nation's largest banks are solvent and he does not expect any of them to fail. At the same time, the chairman expressed concern that the United States might lack the political will to take further measures to shore up the financial system. Although he says he believes the largest banks are solvent and that they're not going to fail, Bernanke said a full recovery will not take place until the system is stabilized. Quote, "The lesson of history is that you do not get a sustained economic recovery as long as the financial system is in crisis." Bernanke noted that banks are unable to raise cash from private investors, as is normally the case, because of fears about their solvency. He said that Lehman Brothers, the collapse of Lehman Brothers, which caused a sharp downturn for the worst last September, proves that you cannot let a large internationally active firm fail in the middle of a financial crisis. I suppose that's the same argument that was used to resuscitate AIG. Also, Mr. Geithner was busy himself over the weekend. He met with his counterparts at the Group of 20 industrialized Western nations at the Group of Finance Ministers south of London. Delegates at the G20 Agenda Forming Summit promised to increase regulations and fight the threat of protectionism. This is all in anticipation of the head of state meeting in early April, the G20. Without providing too many specifics, the finance ministers said in their closing statement that they promise fiscal, monetary, conventional, and unconventional policies to tackle the downturn. This is a quote from the statement. "Our key priority now is to restore lending by tackling, where needed, problems in the financial system head on. We are prepared to take whatever action is necessary until growth is restored. We commit to fight all forms of protectionism and maintain open trade and investment." The G20 head of state meeting begins in London on April the 2nd. And some economic news in the U.S. The output of the nation's factories, mines, and utilities plunged 1.4% in February. This according to the Federal Reserve this morning. Output has now fallen in 4 straight months and 5 out of the last 6 months. The decline in February was worse than what was expected by economists who have been expecting a 0.9% drop. Instead, they got 1.4%. We'll now go to a word from our sponsors. The market still remains up again, and we'll come back with the rest of the news.
Every day, the world wakes up and goes to work, pursuing the unique opportunities that lead the global economy forward. The complexity and close connectivity of today's global marketplace is a true modern miracle that can create unparalleled success. But it takes confidence, passion, innovation, and understanding